your toes for, well, I guess probably your whole leg in real asset type strategies here and there over time as components of what you guys do overall and whatnot. And
yeah,
you're going to get into kind of the topical opportunity set here, which you and the Grafton folks have, which could be of interest to you.
Okay. Yeah, Gita, happy to give you a quick overview. And that way, as you hear what we're able to do, I mean, I need to learn more about Grafton to understand sort of how we could potentially fit and be a financing source and be helpful. But let me give you a flavor for our strategy, and based on that, you probably have a better idea whether or not there's a fit. But the long and short of it is we are structured organizationally as a private equity firm, so our capital is ours. It's locked up. So we have duration on our side. We're not a hedge fund where we have liquidity issues. The investment strategy is foundationally built upon making asset-based investments. Sort of dates back to our days at Merrill Lynch. Deployed roughly $12 billion over the course of a decade at Merrill.
Who just joined the call?
Sorry, this is Andy from Raven. I had another call that ran a few minutes late.
No problem. Hi, Andy.
Yeah, no worries. So the core of the team comes out of the Merrill Lynch side. So this is not new. We've hung the Raven, sign up, but effectively it's the same strategy that we executed on dating back for the better portion of a couple decades now.
I'm just going to have to stop you there for a moment, Brandon. Do you by any chance know a guy named Arshad Zakaria?
Say it again? Arshad
Zakaria?
I do not.
He ran about 2/3 of Merrill Lynch in the, until about 2005. And then he and Tom Patrick left and started New Vernon.
Huh. The name does not ring a bell.
Okay.
I can ask my team members, but myself, it does not ring a bell.
Remember the massive restructuring of Merrill Lynch?
Yes, of course.
Yeah. He was the architect of that.
Got it. Okay. Excellent.
I used to work for him in New York, so that's why I was just wondering if you knew him.
I do not personally, but I would suspect that our founder Josh does for sure. And he was the founder of that alternative investments group at Merrill.
Cool.
And so we're within Raven. We're on our fourth vintage fund. Again, we do two things underneath the umbrella of being asset-based, which is make first lien senior secured loans, as well as actually purchase the asset outright, take title to it and monetize it based on how it trades within its respective industry. So the best way to think about our capital is solution capital, right? A lot of times we're, sort of a unitranche solution, a preferred equity kind of position regardless of structure. Doesn't matter whether we're buy the asset or actually lend against it. A lot of times it has a look and feel of a preferred kind of position. A lot of the underwriting techniques are kind of dating back to the days of, securitizations and so forth. The assets are many, so I need to learn more about Grafton because it's not necessarily something we've touched before. The sectors we are involved in heavily are real estate, from single-family, multifamily, storage facilities, boat basins. We've got specialty finance assets, anything from consumer installment loans, pre-settlement litigation receivables, auto loans, franchisor finance, tax credits. I spend a lot of my time in transportation, so trucking, rail cars, shipping, logistics, a lot of aviation, so anything in the land of engines and aircrafts and teardowns and leasing. Infrastructure assets, which may be more akin to kind of what we're about to talk about with you. Where we've sort of touched and have investments right now are water treatment facilities, coal plants, other municipal assets, industrial equipment, sort of cell phone ground tower lease kind of plays. And then from an IP perspective, our exposure on that side is really in the land of music and film. So royalties, distribution rights associated with both equity and debt positions on both sides. So, I mean, that's us in a nutshell from a deal size perspective. The sweet spot tends to be that $10 to $50 million check. Can we go a little bit smaller? Yes, if need be. But again, how much time, money, effort, legal fees, absorption rate, all that stuff goes into the pie. Going bigger doesn't tend to be a problem, but we're not as competitive when you get to the $100+ million deal sizes because there's a whole host of other guys that just play in a different stratosphere. That's just not who we are. We come to the market with two different products, I guess. One is kind of a mid-teens and above risk profile, right? It can do anything. It understands, LTV levels are, significantly higher than our other product. And effectively, that's split mostly 50-50 between the debt product and the actual equity purchase of the asset. The other product that we have is more of a lower teens, kind of 10, 11, 12% risk profile, loan-to-value ratios in the 50 to 60, 65% region. A little bit more pristine asset, pristine credit risk exposure. Again, the key takeaway I want to make sure is that it doesn't matter whether it's an offshore asset, it doesn't matter whether it's a music deal, film production, some semblance of, as long as what we care about is underwriting the downside. What's the velocity of the cash flows in a liquidation runoff scenario? What's the level of the risk profile when you look at who we're partnering with, from just how they go to market, what's the integrity of management team, et cetera. So hopefully that's given you a sense of probably more than you bargained for, but that's the rough overview of what we look at. Like to learn more about the attachment point and what you're looking to achieve at Grafton.
Yeah, no, that was actually really, really helpful, Brandon, because I thought we were getting on the call to talk about one thing, and I literally wrote down three things as you were talking. So Grafton Asset Management is based up here in Calgary, Alberta. It's about $1 billion in assets under management. We are predominantly energy focused. The bulk of our assets is in the ground and working interest joint ventures. Our current investing vehicle is about $675 million, which has a couple of assets in it. We have our largest investors are like Riverstone Energy out of New York. And then it kind of goes down from there. They have about $300 million with us. We're the first investment firm that they've ever invested with. And so we structured around them. And what I thought we were going to talk about was infrastructure potential at one of our deals. But now I have a couple of things I just love to run by you. So the first thing that we were, I think, going to talk to you about, and I don't know if Ashley sent you the deck on it. Judd, do you know if it was sent, the Pipestone infrastructure?
Yeah. The short version, Brandon and Andy had seen on Pipestone, the infrastructure opportunity.
Well, the bulk of our assets is in oil and gas, as I mentioned, and our current investing vehicle out of CNOR is just doing really, really well with the quality of the assets that we have. And so right now we're focused on IRR optimization because that's frankly how we as a manager get paid. And so we know that we've locked in a pretty nice MOIC on our oil and gas E&P assets. And so one of the two assets that we own two assets in this portfolio. It's a $675 million capital commitment. As I said, Riverstone's the lead in it. We have, one is a 25% non-operated interest with a company called Tourmaline, where we own, production, cash flow, infrastructure, about 25% in over $450 to $500 million of infield gathering, pipelines, compression, gas plants. And we're just starting to think about, do we want to do something there? But the deal that we were talking about was our second deal, which is called Pipestone Oil Corp. This is probably the number one most exciting company that's emerging in Canada. It's in the heart of an area called the Pipestone Montney. We've spent already about $150 million. net on this asset, and we're expecting with everything that we put in place that this asset's going to start cash flowing at about $60 W.